The strangest years to begin investing have definitely been the recent ones. Now, I have to admit that I feel bad for any new investors who are just starting out in the stock market, since it can be quite difficult to navigate these murky waters if you don't know what you're doing. We want to put you on the proper path for investing wisely in turbulent times. That is why in this video, we will share with you beginners how to invest in stocks in 2022. Oh, and if you learned something helpful from this video, it would be lovely if you subscribed. You can also unsubscribe at any point, but as long as you subscribe, you'll always be the first to hear about new money-making strategies as they become released. With that said, I'm going to give you 5 suggestions that Warren Buffett and the other outstanding investors utilize to outperform the market over the long run. So, let's get right into it, shall we? During these times, one of the things that will set apart average investors from quality investors is their ability to control their emotions. Jordan Penderson suggests that we be the trustworthy ones at a relative's funeral. So let's use that as an analogy. It's crucial that we apply that guidance in our financial decisions, especially when investing during and following a market downturn. You see, this is the attitude that 90% of investors adopt when their stocks increase. They go to the bar and brag to their pals about how much money they've made, and they check their stocks at least once a week. Their feelings are completely entangled in the highs and lows of the stock market. The minority of investors who do best are those who act in the exact opposite way from those guys though. When a stock declines, successful investors are really pleased, since it implies that they may purchase more at a discount. They are aware that their returns will be larger if they invest in equities at a lower price in the long run. Buffett asserts that you're dealing with a lot of silly people in the marketplace. It's like a great big casino and everyone else has been boozing. Buy low, sell high. Fortunately, the majority of investors do otherwise. You must invest in markets that you are familiar with if you want to have an edge over other investors and receive large profits. Therefore, I advise you to take a step back and evaluate the topics that you are already familiar with. If you're a young man involved in technology, gaming, artificial intelligence, social media, or any related field, that might work out best for you. If you're older, you may have an advantage in more established industries, maybe hospitality, travel, wine, food, or something like that. Buffett only adheres to the more established business concepts that he is familiar with, such as See's Candy, which sells products on Twitter. That business strategy is well established, and Buffett is aware of it. Or maybe something like insurance, which Buffett spent a lot of time trying to understand. He is so adept at the game that he can choose the business that makes good investments. The exact identical action that Buffett took should be taken by you. As I said, if you're young and you enjoy gaming, you probably have a better notion of what industries will flourish in the future than the majority of the companies that are going to be in charge. Besides this, one of Peter Lynch's most famous comments is both straightforward and brilliant. Know what you own and why you own it, he advises. You see, the majority of investors aim to profit in every sector. They want to discuss all of the businesses they own with their pals at the bar. However, they hardly ever stay in their familiar industries, and they hardly ever fully comprehend the nature of the businesses they run. Because of this, you shouldn't act like most investors. If I approach a total stranger who had never played poker before and asked them if they wanted to join me and my buddies for a game, would they accept my invitation? That person would be a fool if he agreed to the game with a $500 contribution, since they have never played before and he will lose money and get whipped. And if we apply it to the stock market, you'd be surprised at how many novice investors don't genuinely understand the fundamentals of making investments. And after a year, 2 years, or 3 years, they ultimately lose money. Before we proceed, we would love to hear your own experiences while navigating through investing as a beginner. That way, you can also learn from others' real-life experiences as well. With that said, let's continue. Here are several fundamentals you should be aware of if you're new to the stock market and investing, especially during these uncertain times. One of the most crucial indicators to understand is the PE ratio. In essence, it assesses how much you spend on the stock in comparison to the revenue it generates. The return on equity is another factor. This metric is excellent for determining how well our company generates money. Do you understand how stock market orders work? How do limit orders work? A market order? A stop limit order? Before making an investment, it's important to understand these factors so that you can employ a variety of fundamental techniques, such as the Warren Buffett strategy of value investing, which entails paying less than the item's true value. Are you familiar with the dividend aristocrat tactic? A collection of companies that, historically speaking, can be purchased using dollar cost averaging and outperform the market over the long term. Before you start investing, it's crucial that you understand these essential methods. Understand the PE ratios and gain a basic understanding of these fundamental strategies. Ignoring the minutia is the next skill to develop. The majority of investors find it challenging to adhere to even the most basic investment guidelines, such as this one. The weekly or daily news of the financial market is their obsession. The problem is that every time you hear any sort of news, your dopamine levels spike, and as a result, 90% of investors become addicted to the short-term events in the stock market. Even though it has a detrimental impact on how you invest and eventually how much money you get from investing, I wouldn't have a problem with this. You might not see the long-term patterns you are going through if you are only thinking about the very short term, which is one of the issues of doing so. These are ordinarily little dots of a longer-term pattern that is happening if you look at the stock market over a week or even a month. Therefore, if you are a shareholder who is emotionally invested in the short term, your decisions will be based on that. This causes lower overall returns on investments. According to Buffett, only invest in things that you would be content to own for 10 years if the market were to crash. Don't stress over the minor details or the daily news. The next thing you should focus on understanding is market cycles, especially in 2022, when we're nearing the end of a cycle. Finding out which stocks will do well during time periods is what I'm referring to now. Transportation, technology, and capital goods stocks often perform well in the early to mid stages of the market cycle. Why? Things are starting to grow, the economy is heating up, and transportation needs are increasing as a result. During these moments, technology stocks typically sell for a large sum and have the potential to soar. 10 years ago, just as the market was beginning to heat up, was the ideal time to invest in Netflix, Tesla, and Amazon. But as the cycle progresses, the more conservative equities begin to do better, the likes of healthcare and consumer non-cyclical. Why is that then? Because even during a downturn in the economy, people still need to eat and have access to things like toothpaste, soap, and clean water. Customer non-cyclicals are therefore safer to own. Additionally, they require care for their health. Healthcare stocks, therefore, perform well in the latter stages. You should be wrapping your head around these concepts as a novice entering the stock market. You must be aware of when and which stocks do successfully. As per an adage, even if you purchase the world's strongest stock, you risk losing money if it is in a weak industry. Therefore, if you're just getting started investing, you probably wish you had done it 10 years ago when the market and economy were just getting going. However, at the end of the day, all you have to think about is the present conditions of the market. These modest pointers that I gave you should aid you in navigating the waters of these particular market situations, both this year and in the future. Thanks for watching. I hope you learned something useful today. And if you haven't already, make sure to subscribe and hit the notification bell so you'll be updated whenever we upload new videos. Till the next one, goodbye!